Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, uh, I want you to picture something.
Okay, I'm picturing it.
You are at a summer barbecue, right? Maybe it's a 4th of July party, and you are standing around the grill with a group of friends. Have you ever noticed how the way people talk about money at these parties totally shifts depending on how the stock market is doing?
Oh, it is entirely predictable. I mean, the mood of the broader market absolutely dictates the mood of the backyard patio.
Right. Sometimes, like, nobody wants to even utter the word stocks. If you bring it up, they suddenly get very interested in the potato salad or the weather.
Yeah, anything but their 401k.
Exactly. But other times, like right now in the summer of 2026, you just can't get away from it. The guy flipping the burgers is giving you, unsolicited tips on semiconductor supply chain.
Which is always a warning sign, by the way.
For sure. And today, we are taking a deep dive into that exact phenomenon. We are using legendary investor Peter Lynch's cocktail party theory to decode the wild, hyper-focused AI and semiconductor market we are seeing right now in July 2026.
It is honestly the perfect lens for this moment. It really is.
It is. And just a quick note for you listening, under the current economic backdrop of the Trump administration, the market has been on a truly fascinating ride.
Very fascinating.
But before we dive into the details, I want to make it abundantly clear that we are not endorsing any political viewpoints or taking any sides here. Whether right-wing or left-wing, our only goal is to impartially report on the economic environment and convey the ideas found in the market analysis we are looking at today.
Yeah, we're just looking at the numbers and the psychology.
Just the numbers.
And that is a vital distinction because Peter Lynch's theory isn't a complex math equation. If you are listening to this and worrying that we are about to start running discounted cash flow models, you can relax.
Thank goodness, because I left my calculator at home.
Right. And, a discounted cash flow model is just a fancy Wall Street term for trying to guess exactly how much cash a company will make every year for the next decade to figure out what it's worth today. But we aren't doing any of that.
Perfect. Keep it simple.
Exactly. Instead, this theory is a brilliant gauge of crowd psychology. It tells us how risky the market is based purely on how much everyday people take rising stock prices for granted.
Okay, let's unpack this. Because before we can really understand the absolute frenzy happening with artificial intelligence right now, we need to establish a baseline.
Right. We need to know what normal looks like.
Yeah, like what does a market look like when it's safe,
Yeah.
when it's actually ripe for opportunity? According to Lynch, there are 4 stages to this cocktail party, and I'm guessing stage 1 is the potato salad phase.
You nailed it. We have to start at stage 1, which is the baseline. So in stage 1, the market has usually been down for a while, or it's just been completely flat and boring. People actively avoid talking about stocks.
It's a taboo subject.
Totally taboo. If you are at that barbecue and someone asks what you do, and you say, well, I'm an equity fund manager, they will politely nod, maybe look a little sorry for you, and immediately change the subject to safer things.
They want to talk about cash or real estate or gold.
Or, how about those local sports teams?
Precisely. Total avoidance.
But ironically, historically speaking, this is the absolute best time to invest. The risk is lowest because expectations are at rock bottom. Nobody expects anything good to happen.
That makes sense.
Then we move into stage 2. The market recovers a bit, prices start to tick up, but people are still highly skeptical.
They've been burned before.
Exactly. They will acknowledge the rise, but they'll say things like, isn't it still too risky? Or, I think it's a trap. I'm going to wait it out.
I always think about stages 1 and 2 like finding an incredible, completely empty restaurant.
Oh, I like that.
Yeah, you walk in, the atmosphere is quiet, the food is amazing, and it's incredibly cheap because literally nobody knows about it yet. You're eating a 5-star meal for the price of fast food.
That is a great way to think about it.
And the thing is, this isn't just a history lesson. This is happening right now in certain parts of the world, isn't it?
It is. It's easy to look at the market today and think everything is overheating, but that's an illusion caused by where the spotlight is pointing.
Right.
According to recent analysis by Reuters from July 1st, 2026, European stocks fit this stage 2 profile perfectly right now.
Wait, really? So while everyone here is staring at U.S. artificial intelligence companies, Europe is just sitting in the dark?
Pretty much. I mean, European industrials, financials, and defense stocks are sitting there with very low valuations and almost zero AI exposure.
Wow.
Yeah, they are classic stage 2 investments right now. The broader European index, the SDOXX 600, just recorded its strongest weekly gain in over a month, driven entirely by these boring sectors.
Okay, when you say boring, what are we actually talking about? Because I want the listener to really picture this.
We are talking about traditional banks making standard loans. We are talking about companies manufacturing tractor parts or, you know, building physical defense
Just
infrastructure.
meat and potatoes businesses?
Exactly. They are quietly attractive, offering solid fundamentals and steady dividends, while the massive crowd of investors is looking entirely elsewhere.
So the empty restaurant is over in Europe right now. They're serving up great financial and defense stocks, and there's no line at the door.
Nope, you can walk right in and get a table.
But obviously, Wall Street doesn't stay quiet for long. How does a market cross the bridge from nobody caring to absolute frenzy?
Well, that brings us to the pivotal shift. Think about what happens when your empty restaurant gets a write-up in a major food magazine.
Right, it gets a Michelin star, and suddenly every single person in town wants a table. You can't even get a reservation.
Exactly.
And that brings us to stage 3 of the cocktail party theory, which, if I'm reading the room right, perfectly describes the current AI boom we are living through right now.
It perfectly describes it. In stage 3, the dynamic at the party changes completely.
How so?
Well, the people who were asking about real estate or changing the subject to the weather, now they are seeking you out. They actively ask the fund manager or just the knowledgeable investor friend what stocks they should buy.
So they want the hot tips.
Yes. The conversation shifts fundamentally from fear to FOMO, the fear of missing out.
And based on data from Business Insider, the AI infrastructure boom in this first half of 2026 has pushed this conversation completely mainstream.
Oh, completely.
Like, we aren't just talking about the big, famous U.S. tech giants anymore. I'm hearing everyday investors, people who previously only bought index funds, chatting about data centers, high bandwidth memory, cooling systems, and the intricate details of supply chains.
It's wild.
It is. We are seeing Asian stocks like Samsung Electromechanics, Kioxia, Yageo, and Unimicron surging hundreds of percent.
Right. And when you hear your dental hygienist talking about the supply chain bottlenecks of high bandwidth memory chips in Taiwan, you know you are deeply entrenched in stage 3.
So true.
The awareness has penetrated every single layer of the investing public.
I want to pause on those technical terms for a second, because this is where a lot of people just nod along so they don't look dumb.
Sure.
People are throwing around terms like high bandwidth memory and liquid cooling. How do these things actually solve the physical limitations of AI? Why is everyone so obsessed with them?
That is a great question. So think of standard computer memory like a sprawling, flat parking lot.
Okay, a big parking lot.
Right. If you want to get a lot of data, or cars in this analogy, in and out quickly, they have to drive all the way across the lot. It takes time and energy.
Makes sense.
High bandwidth memory, or HBM, is like stacking that parking lot into a massive, ultra-efficient skyscraper garage right next to the processor.
Oh, wow. So everything is just compacted vertically.
Exactly. You can move massive amounts of data back and forth instantly, using way less physical space and power.
And I'm guessing packing all that data into a skyscraper garage creates a ton of heat.
Exactly the issue. These AI data centers are massive warehouses running thousands of these chips at full capacity.
Right.
They literally run so hot that traditional air conditioning can't keep up. The servers would melt.
Yikes.
So companies are having to design intricate liquid cooling systems, like running specialized fluids directly over the chips just to keep the concrete buildings from catching fire.
Okay, that is wild. But see, this is where I have to push back a little on behalf of the listener.
Go for it.
You just explained why this technology is completely necessary. Like, AI isn't a fake internet fad,
No, it's very real.
right? The data centers are physically being built out of concrete and steel. The demand for power is real. The demand for these cooling systems and memory chips is backed by actual massive corporate spending. So if the story is actually true, and these companies are making money hand over fist, why is it considered risky?
It is the exact trap that catches so many investors in stage 3. The danger here is confusing a good story with a good price.
Wait, so when you say a good story versus a good price, are you saying that even if a company, say, cures a disease or revolutionizes computers, the stock could still be a terrible buy if the whole world already knows about it?
That is exactly it. When a technology is brand new, you ask, is the AI theme right? Will this change the world?
Right.
And the answer right now is yes, it certainly will. But in stage 3, you shouldn't be asking if the theme is right anymore.
What should you be asking?
You must ask, how much of this future success is already baked into the current stock price?
Ah, so it's like buying a ticket to a concert.
Okay, let's hear it.
It might be the best band in the world. The story is real. They're going to play an amazing 3-hour show.
Yeah.
But if you pay a scalper $10,000 for a nosebleed seat, it's a terrible purchase.
Yes.
The band is good, but the price you paid guarantees you'll be disappointed.
That is a brilliant analogy. Even a great world-changing company becomes a bad investment if you pay a perfect price for it.
Right, because there's no room for error.
Exactly. Because if you buy a stock where a decade of flawless hypergrowth is already priced in by the market, what happens if they just have a normal good year?
The stock crashes because everyone was expecting perfection.
Precisely. In stage 3, the market has already priced in all the good news. To keep going up, it needs unexpectedly incredible news. And that is a very hard standard to maintain.
But let me challenge that for a second. If I'm an everyday investor and I listened to this logic back in 2024 and sold my NVIDIA stock because I was terrified of stage 3 FOMO, I would have missed out on massive life-changing gains.
That's true. You would have.
So how do you know when being cautious just becomes a premature mistake?
You are hitting on the hardest part of investing. Stage 3 can last a lot longer than rational people think it should. The point isn't that you must liquidate your entire portfolio the second your neighbor mentions a stock. The point is recognizing that the nature of your risk has changed.
You're not the only one in the restaurant anymore.
Exactly. You are no longer riding an undiscovered wave. You are playing musical chairs with a very crowded room.
Which means we are walking on increasingly thin ice, even if the underlying ground is solid. And that pricing problem hits absolute critical mass when we transition to the final stage, when we go from asking for advice to giving it.
Welcome to stage 4, the danger zone.
The danger zone.
In Lynch's original theory, this is when the everyday investor at the barbecue stops asking questions and starts telling the professional fund manager what to buy.
Wow.
The crowd is no longer seeking validation. They are fully convinced they have the magic formula.
Like, hey man, forget your diversified portfolio. You are an idiot if you don't put everything into this one liquid cooling manufacturer.
Yes, exactly that. People ignore valuations entirely. They focus 100% on the story, and the most dangerous 4 words in investing start echoing around the party.
Which are?
This time is different.
Oh boy. And looking at the data, it shows clear stage 4 symptoms in early July 2026. According to Barron's and MarketWatch on July 4, we saw something completely wild.
What happened?
Well, Micron stock plunged below $1,000, even though it was already up 242% for the year. Yet, almost instantly, Korean AI giants SK Hynix and Samsung Electronics, which make up over half the entire KOSPI index in South Korea, violently rebounded 11% and 8% respectively, purely on news reports about a new contract.
It's just massive volatility.
And here's the real kicker. Recent analysis showed this was driven heavily by retail investors using leveraged derivatives.
And that detail right there about leveraged derivatives is the defining characteristic of stage 4 today.
Okay, time out. I know leverage generally means borrowing money, but how does a derivative actually force someone to sell a stock they didn't want to sell? What is the actual mechanic happening there?
Let's break it down. A derivative is basically a financial contract that gets its value from an underlying asset, like a stock.
Okay.
When retail investors use leveraged derivatives, they are essentially putting down a tiny bit of their own cash, say $10, to control $100 worth of stock.
So they're borrowing the rest.
Yes, the broker loans them the other $90.
Sounds great when the stock goes up.
Oh, it's fantastic when it goes up. Your gains are multiplied. But if the stock drops, say it drops from $100 down to $89, the broker who loaned you the money starts to panic.
Because your $10 is gone.
Exactly. They see that your $10 of equity is completely wiped out, and their loan money is now at risk.
And that leads to a margin call.
Exactly. The broker issues a margin call, demanding you deposit more cash immediately.
And if you can't?
If you can't, the broker automatically sells your position to protect themselves. You have no choice in the matter.
So it's like crowding 100 people into a tiny room, and they're all balancing on one leg. If one person trips, They knock over the next person, and suddenly the whole room goes down in a forced chain reaction.
That is a perfect visualization of a cascading sell-off, and it's important to note how the cocktail party itself has evolved.
How so?
Well, Peter Lynch wrote this theory decades ago when people literally stood around with martinis in physical rooms. The modern cocktail party isn't a physical room.
Right, it's online.
It's Reddit, it's X, it's Telegram groups, and it's the widespread availability of these leveraged ETFs right on your smartphone.
Because the party is digital, hype, and panic move in hours, not months.
The speed of information transmission has completely altered the physics of Stage 4.
It's hyperspeed.
When everyone in a digital chat room is highly leveraged on the exact same optimistic belief about AI, the market stops caring about the fundamental health of the companies.
It just becomes about the momentum.
Right. It becomes incredibly fragile to even tiny pieces of bad news. The rapid 11% swings we saw with SK Hynix, that is the signature of a highly leveraged, hyper-crowded trade. It's not investing based on what a company will earn in 5 years. It's trading based on what you think the crowd will do in the next 5 minutes.
So what does this all mean for you, the listener? If the AI party is getting this wild, this crowded, and everyone is balancing on one leg while drinking digital martinis, should you just grab your coat and go home, sell everything, and hide your cash in a mattress?
Not necessarily, and this is where the nuance of 2026 comes in.
Okay, tell me more.
The trick is realizing that the market isn't just one single room. It's highly dangerous to label the entire global stock market as being in Stage 4.
So we aren't looking at a massive market-wide bubble.
No, we are in a split market. We have to compartmentalize. AI and semiconductors might be pushing into Stage 3.5 or Stage 4, where the hype is deafening.
Right.
But non-AI sectors are hovering way back around Stage 2.
Now, here is where it gets really interesting for anyone trying to figure out their next move. Recent analysis from Investors Business Daily right around July 4 highlights this exact rotation.
Yeah, the rotation is key.
While the NASDAQ, which is super heavy on those tech and AI stocks, actually dipped below its key moving averages due to AI sell-offs, the Dow Jones climbed 2% for the week.
Exactly.
Money isn't just evaporating, it's moving. It's quietly flowing into less crowded sectors like biotech, healthcare, transportation, and software.
This is the rotation mechanism of a healthy, broader market. When the AI room gets too hot, the smart money quietly exits out the back door and walks down the hall to those empty, air-conditioned rooms.
You mentioned the NASDAQ dipping below its key moving averages. For someone who doesn't stare at stock charts all day, why does a line on a graph cause big institutional money to rotate into healthcare?
Think of a moving average like the general speed of traffic on a highway over the last 50 or 200 days.
Okay.
It smooths out all the daily bumps and potholes. When a major index like the NASDAQ drops below that long-term average, it signals to the computer algorithms and institutional investors that the broader momentum has stalled.
Ah, the highway is backed up.
Exactly. So instead of sitting in traffic, they take an exit and look for a different route that is picking up speed, which right now are those non-tech sectors.
So let's make this highly actionable for the listener.
Yeah.
How do we synthesize a strategy out of all this?
Right.
We have the hyper-crowded AI party, and we have the empty European defense and U.S. healthcare restaurants. What is the actual play?
First, as we discussed earlier, you don't need to blindly sell all your AI stocks. If you hold great companies, holding them long-term is still a valid strategy.
Good to know.
However, you absolutely must manage your weight. If your portfolio has grown so much that AI now makes up 80% of your total holdings, it's time to trim. Take some chips off the table.
And I imagine the first thing to trim is the leverage.
Without a doubt, trim back on the high-risk, leveraged AI bets. If you are holding leveraged ETFs or short-term options on semiconductor companies right now, you are playing with fire in a Stage 4 environment.
Reduce the leverage. Got it.
And then take that cash and go look for the quiet rooms at the party.
But how does an everyday investor actually do that? Like, how do I find a Stage 2 stock without just blindly throwing darts at a list of healthcare companies?
You want to look for businesses where the earnings are steadily growing, but the hype is non-existent. A great starting point is looking at the price-to-earnings ratio, or PE ratio.
Okay, break that down for me.
If a tech stock has a PE of 80, it means investors are paying $80 today for every $1 of current profit because they expect massive growth.
Right.
You want to look for mature companies in healthcare, industrials, or utilities with a PE closer to 15 or 20. Look for companies that pay a steady dividend.
You essentially want to buy the boring stuff.
Yes, that is the essence of smart investing. You want to buy before the crowd arrives, not after they have already bid the price up to perfection.
Makes sense.
You want to find assets where the expectations are low, so any good news results in a massive price increase, rather than assets where expectations are so high that any slight disappointment causes a crash.
Okay, let's bring this all together. Today we use Peter Lynch's cocktail party theory to take the temperature of the July 2026 market.
We covered a lot of ground.
We really did. We saw how the market isn't just about math, it's about the conviction of the crowd. We started at the empty restaurant of stage 1 and 2, looking at overlooked European industrials.
The boring, quiet rooms.
Right. Then we explored the FOMO of stage 3 as AI infrastructure, like high bandwidth memory and liquid cooling, went completely mainstream.
The Michelin star restaurant.
Exactly. And finally, we warned about the hyper-leveraged digital danger zone of stage 4, where everyone is an expert, margins calls trigger avalanches, and prices are priced for absolute perfection.
And the overarching lesson here is that Lynch's theory isn't a magic crystal ball for timing the exact top of the market.
Right. No one can do that.
You can't use it to predict what the market will do tomorrow at 9:30 a.m. Rather, it's a mirror. It is designed to help you see exactly where you stand in the crowd.
I love that. Peak danger doesn't come from bad news. It comes from good news becoming so blindingly obvious that every single person is betting on it.
Very well said.
When there is nobody left to buy, because everyone already has, that is when the market turns.
Precisely. Which leaves us with a very important question to consider regarding your own portfolio as we wrap up.
What should we be asking ourselves?
If the safest and most profitable investments are historically made when everyone else thinks it's a terrible, boring, or dead idea, what is the one sector today that your friends at that barbecue would actively laugh at you for buying?
Oh, that's a great question.
Because whatever that sector is, that might just be your biggest opportunity right now.
Now that is something to chew on next time you're at the grill. Don't forget to subscribe and hit that like button.